If you were born before 1962 and you share a bank account with anyone, a spouse, an adult child, a sibling, there are 3 rule changes that went into effect that your bank was not required to tell you about, and almost certainly did not. Here is what makes that so frustrating. The account you set up 5 or 10 years ago may have been perfectly structured at the time, but rules change, and from the outside, nothing looks different. The balance is there. The statements arrive, everything appears fine. But the protection underneath that account may not be what you think it is. Banks are not legally obligated to notify you when federal rules shift. Their job is to hold your deposits. Explaining how to better protect those deposits is simply not part of that job. Nobody is going to call you. No letter is coming. By the end of this video, you will know exactly what these 3 changes are, whether your account is affected, and 3 specific steps you can take this week, every one of them free. The 3rd change is the one that surprises people most. It also has the simplest fix. Stay with me. I have spent over a decade working with seniors and their families on retirement financial planning, specifically on the kinds of quiet structural problems that never show up on a bank statement until it is too late. The pattern I see most consistently is this. A senior adds an adult child to their account. Completely reasonable. They want help with bills if their health declines. It takes 15 minutes at the bank. Nobody explains what that simple decision legally creates. Years later, that family is sitting across from a Medicaid caseworker or an accountant, learning for the first time what that joint account actually means on paper. I have seen this cost families anywhere from $4,000 in unexpected tax filings to over $40,000 in Medicaid reimbursement claims. Not because anyone did anything wrong, because nobody told them the rules had changed. You worked decades to build what is in that account. It deserves 5 minutes of your attention this week. Before I get into the 3 items, I want to clear something up because 2 groups of people are already thinking this does not apply to them, and both groups are wrong. The first group is thinking this is for people with serious money in the bank. It is not. The protection issues we are covering today apply whether you have $8,000 saved or $80,000. The risk is structural. It has nothing to do with your balance size. The second group is thinking this only affects wealthy families with complicated estates and lawyers on retainer. It does not. The most common version of this problem I see involves a perfectly ordinary checking or savings account at a credit union or a community bank. Nothing unusual, nothing complicated, just an account that was set up one way and quietly became something different on paper. And if you are watching this because your parent asked you to, or because you recently added yourself to their account to help them manage things, please do not go anywhere. There is something in this video that applies directly to you, and it genuinely matters. Both groups are working with incomplete information. That is exactly what we are going to fix right now. I want to tell you about Dorothy, 71 years old, Columbus, Ohio. She spent 23 years working in a school cafeteria, raised her kids, and when her husband passed away 3 years ago, she was left with one savings account holding about $34,000. That was her cushion, everything she had liquid. Her daughter Angela suggested she be added to the account, just in case something happened, just to make it easier to help with bills if Dorothy's health ever made that necessary. Dorothy agreed. They went to the bank together. It took 15 minutes. The teller was friendly. Nobody mentioned what joint ownership actually means under the law. Why would they? 2 years later, Dorothy applied for Medicaid assistance to help cover her in-home care costs. The caseworker reviewed her finances. The full $34,000 in the joint account was counted as Dorothy's asset, which was expected. But then the caseworker flagged $6,200 in withdrawals Angela had made over those 2 years, paying Dorothy's household bills. The system classified those withdrawals as uncompensated transfers. That triggered a 47-day Medicaid penalty period. During those 47 days, Dorothy paid $3,900 out of pocket for care that should have been covered. She did not do anything wrong. Angela did not do anything wrong. Had Dorothy added Angela as a named beneficiary instead of a joint owner, none of it would have happened. That situation with Dorothy is exactly why I put together these 3 specific rule changes, because this is preventable. Let me start with the first one. Here is the first rule change. It is about FDIC deposit insurance on joint accounts, and most people have no idea how it actually works. According to FDIC.gov, and this is directly from their deposit insurance page, your deposits are insured up to $250,000 per depositor per institution. But for a joint account, that protection extends differently. A joint account can be insured up to $250,000 per co-owner. That means a 2-person joint account can have up to $500,000 fully insured, but only if the account is titled correctly and both owners are documented as equal co-owners. Here is where most people get trapped. You opened a joint account 5 or 10 years ago. It worked fine. You never checked the account title or the ownership structure since then. You assume it is covered the way you think it is. But many joint accounts are titled incorrectly or lack the clear equal ownership documentation the FDIC requires for that per-person coverage. If your account is labeled as a joint account but not structured with that equal co-owner designation, the FDIC may only insure $250,000 total, not per person. For a couple with $380,000 across joint accounts at a single bank, that could mean $130,000 completely uninsured. This is not theoretical. The FDIC has paid claims in bank failures as recently as 2023. Here is what to do this week. Call your bank or visit in person. Ask specifically, is our joint account titled as a joint account with right of survivorship with equal co-owner FDIC coverage? If they cannot answer clearly, ask for a branch manager. You can also use the FDIC's free electronic deposit insurance estimator at ed.fdic.gov. It takes under 5 minutes and gives you your exact coverage status. That is the first one. And now that you understand how the coverage actually works, the second rule change makes a lot more sense, and it has more dollars attached to it. Item 1 was about protecting what is already sitting in your account. Item 2 is about what happens the moment you give someone else legal access to it. This one has 2 separate financial exposures. The first is IRS gift tax. The second is Medicaid transfer penalties. Either one can cost far more than most people realize. Let me explain the gift tax angle first. When you add an adult child to your bank account as a joint owner and they withdraw funds, even if it is to pay your bills, even if it benefits you directly, the IRS can classify those withdrawals as gifts from you to them. For 2025, the annual gift tax exclusion is $19,000 per person. If your adult child withdraws more than that in a single calendar year, you may need to file IRS Form 709, the gift tax return. Most people think gift tax only applies if you are wealthy. It does not. The filing requirement exists regardless of your estate size. The actual tax may not be owed, but the form may need to be filed, and if it is not filed, that becomes a separate problem down the line. Now the Medicaid angle. If you apply for Medicaid within 5 years of those withdrawals, that 5-year window is called the look-back period. Those withdrawals may be flagged as uncompensated transfers. That triggers a penalty period where Medicaid refuses to pay for care you need. I saw this happen in Florida. A parent had a joint account with an adult child. In 2022, that child withdrew $15,000 to help with household expenses. 2 years later, the parent applied for Medicaid. The caseworker flagged that withdrawal as uncompensated. The penalty period lasted 38 days. The parent paid $2,850 out of pocket for care that should have been covered. Here is what to do. Ask your bank for written documentation of every withdrawal made from your joint account in the past 5 years. Then take that documentation to a free SHIP counselor, that is the State Health Insurance Assistance Program, before you apply for any Medicaid benefit. Find your counselor at shiphelp.org. And if you are the adult child watching this, if you added yourself to your parents' account to help them, this applies to you directly. The withdrawals you made with the best intentions are on record. You need to know what that record shows. If what I have covered so far would have saved Dorothy in Columbus $3,900, imagine what the next video in this series is going to be worth. Next week, I am covering what happens to a joint account when one owner dies, including the one move that bypasses probate entirely and transfers your funds in 48 hours instead of months. Hit subscribe right now and turn on notifications. That one cannot wait. Now, item 3. This is the one I said would bother me, and I meant that. Here is what genuinely bothers me about this one. Banks have a legal right to freeze a joint account if they suspect elder financial exploitation, even if you do not want it frozen, even if you do not believe you are being exploited, even if you urgently need access to your own money, and they do not have to tell you in advance. Under updated FinCEN guidance and the Senior Safe Act, actual federal law banks are encouraged and legally protected when they report suspected elder financial exploitation. That is genuinely well-intentioned. It is supposed to protect seniors. But here is the problem. Accounts are sometimes frozen based on automated transaction flags, not actual exploitation. An unusual pattern triggers an algorithm. The account gets frozen. You find out when you try to withdraw your money. I have seen this happen. A 74-year-old woman in Phoenix. Her son was a joint owner on her account. She needed roof repairs. She made 3 large ATM withdrawals in 1 week to pay the contractor. The bank's automated system flagged the pattern as suspicious. The account froze for 11 days. No warning, no advance notification. She only found out when she went to the branch in person to make another withdrawal. No income threshold applies here. This can happen to any joint account holder regardless of balance size. Here is the protection most people do not know exists. The CFPB, the Consumer Financial Protection Bureau, publishes a guide called Managing Someone Else's Money that explains your rights when an account is flagged or frozen. It is free at consumerfinance.gov/older-Americans. But here is the actual fix. Call your bank this week and ask them to document your account as actively managed by a trusted contact person of your choosing, not a joint owner, just to contact someone you authorize to receive account notifications and help monitor activity. That single conversation creates a record that protects you from automated freezes and from actual exploitation simultaneously. One call, two protections. Now here is something I want you to hear before item 4 because item 4 is shorter, but I am not going to skip past it. It is the one that catches people who think the first 3 do not apply to them. I want to speak directly to anyone watching this who does not own a home, anyone renting, anyone whose parent is in assisted living or a nursing facility. This item is specifically for you. I am not going to rush past this one just because the dollar amounts look smaller on the surface, because when you stack this on top of everything we have already covered, it changes the entire math. Many people add a family member to their bank account as a joint owner when what they actually want is for that person to receive the money after they pass away. Those are two completely different legal arrangements. A joint owner has access and legal claim to the money right now. A named beneficiary has zero access while you are alive but receives the funds directly when you pass, completely outside of probate. Here is why this matters if you are managing Medicaid eligibility concerns from item 2. If you add a beneficiary instead of a joint owner, you remove the transfer penalty risk entirely. Your money still goes exactly where you want it. But there is no uncompensated transfer flag, no 5-year look-back exposure. A beneficiary designation costs nothing. It removes probate exposure that can cost an estate between $1,500 and $8,000 in legal fees depending on your state. Combined with the FDIC titling fix from item 1, you have now addressed both the insurance gap and the inheritance gap in 2 separate conversations. Here is what to do. Ask your bank for a POD form. That stands for Payable on Death. It is free at virtually every bank and credit union in the United States. It takes about 10 minutes to complete. That is it. All right. Item 5. I told you at the beginning this was the one worth staying for. Here it is. I told you at the beginning that the third rule change would be the one that surprises people most and has the simplest fix. This is it. Account titling errors are the single most common structural problem I find in senior bank accounts. When an account is labeled in a way that does not match your actual legal intentions for ownership, survivorship, or who receives the money when you pass, that one mistake affects everything. Your FDIC coverage, your Medicaid eligibility, your estate transfer, your tax reporting, everything. This is not a rare edge case. This is the most common thing I see when I compare how a senior's accounts are actually set up versus how they think they are set up. And it is almost always fixable in a single branch visit. Here is the easiest action step of all 5 items. Call your bank and say these exact words. I would like to review the title and ownership designation on all of my accounts to make sure they reflect my current intentions. That is it. That is the entire action. You do not need a lawyer. You do not need to explain further. A bank associate is required to help you. One branch visit can fix everything simultaneously. You correct your FDIC coverage gap from item 1. You clarify ownership to reduce Medicaid transfer risk from item 2. You update your trusted contact documentation from item 3. You add a POD beneficiary from item 4. One conversation, all 4 items addressed. Ask to review the account ownership and beneficiary designation form. The exact name varies by institution, but every bank has one. Request a printed copy for your records. If you are 65 or older and you have not reviewed this since you opened the account, and most people have not, there is a meaningful chance something has drifted from what you intended. Not because you did anything wrong, because life changed and the paperwork did not. Here is something that elder law attorneys and fee-only financial planners do for their own parents that almost never makes it into general financial content. The professionals who specialize in this field use a 3-account strategy. A primary checking account titled individually with a POD beneficiary. A joint convenience account that gives an adult child access without giving them legal ownership rights. And a separately titled FDIC Maximized Savings Account, or CD. That combination gives you maximum protection across 4 separate categories simultaneously: deposit insurance, Medicaid eligibility, estate transfer, and exploitation protection. Why does nobody talk about this strategy? Because no one product is being sold. Banks do not promote this configuration because it requires 3 separate conversations and generates zero-fee revenue for them. Financial advisors rarely bring it up for free, but it is completely available to you right now, at any bank, at no cost, using account structures that already exist. Every single component is available through your existing bank: the convenience account, the POD designation, the individual title review. These are all standard banking services. None of them require an attorney, none require a financial advisor, none cost $1. Let me show you exactly what this looks like when everything comes together. Because Dorothy from Columbus, I told you about her at the beginning, her story did not end with that $3,900 loss. Dorothy did not give up after that $3,900 penalty. She watched something like this video. Actually, she did. She brought her daughter Angela with her to the bank. Dorothy was carrying 3 separate exposures simultaneously. First, her FDIC coverage gap. $34,000 in a joint account with incorrect titling. That gap was real. Second, her Medicaid transfer exposure. Angela's withdrawals were on record. Another penalty period could happen again. Third, zero beneficiary designation. When Dorothy eventually passed, probate would consume an estimated $2,200 of savings that Angela should have inherited directly. 3 problems. 3 simple actions to fix them. Dorothy requested an account title review. She converted Angela's access from joint ownership to a convenience account designation. She added Angela as a payable on death beneficiary on the savings account. Nothing about Dorothy's life changed. She still shops at the same grocery store. Angela still helps with the same bills. The balance is identical, but the structural risk to that $34,000 is gone. Removing the probate exposure alone saves her estate $2,200. Correcting the FDIC titling ensures her full balance is insured without gap. The convenience account removes any future Medicaid transfer flag. 3 actions, 3 separate protections activated. She did not discover new money. She stopped losing what she had already earned. And she deserved that. So do you. Here's exactly what to do this week. 3 steps, 3 days. None of this costs $1. Monday. Call your bank's main customer service line. Say this: I would like to schedule a branch appointment to review the ownership title and beneficiary designations on all of my accounts. That phone call takes 10 minutes. The branch appointment takes 30 minutes. Tuesday. Call your local SHIP counselor. That is the State Health Insurance Assistance Program. Ask them to review your accounts for Medicaid look-back exposure before you make any changes. Find your counselor at shiphelp.org or call 1-800-677-1116. That is the Elder Care Locator, a free federal service. This call takes 15 to 20 minutes. Wednesday. Go to ed.fdic.gov. That is the FDIC's free electronic deposit insurance estimator. Enter your account information. Verify your current coverage status. If you find a gap, print the results and bring them to your bank appointment. This takes 5 minutes. That is it. 3 free actions across 3 days. You have 2 additional free resources: SHIP counselors at shiphelp.org and the CFPB's Office for Older Americans at consumerfinance.gov/older-americans. They publish a free guide called Money Smart for older adults. Both are completely free. Both exist specifically to help you navigate this. 3 days, 3 phone calls, 3 completely free actions, and every single dollar in that account stays where it belongs, with you. Before you go, I want to be honest with you about something, because I think you deserve that. Everything in this video is real. These programs exist. These rules exist. These risks are documented. But the exact dollar amounts, coverage limits, and Medicaid rules vary by state and by your specific situation. What applies to someone in Ohio may work differently in Texas. Please use the free resources I named SHIP Counselors, the CFPB, before making any account changes. This video is education. Your specific situation deserves a real conversation with a professional who knows your state's rules. I am telling you this not to cover myself legally. I am telling you this because I want what you do next to actually help you. Now, if someone you know has a joint bank account and has not seen this yet, please do not leave without doing one thing. Think about one person right now, a parent, a neighbor, a friend from your church, someone who has a joint account and has never had this conversation. Share this video with them today, not as a subscription request, as a gift. You could hand them the information that prevents a $3,900 mistake or a $40,000 Medicaid problem completely free. It will not cost you a thing, but it might change everything for them.